Let's get a little bit more analysis. Two people who've been sitting at the edge of their seats for the last couple of hours. We thank you so much. Max Grinikoff joins us around the table, U.S. equity derivative strategist over at UBS Investment Bank, and Raphael Thuin, head of capital market strategies over at TKO Capital. Thank you both so much. Max, I want to start with you because coming into what is a historic day, an unexpected day for a lot of people, the trade that we kept hearing was go long vol. That's the only trade that works in a world of uncertainty. Is that the reason we're not seeing panic in the markets right now?
Exactly. Investors were well defensively positioned heading into this event. We saw volatility risk premia heading into elections, not at records, but at multi-year highs, roughly call it 10 to 12 points. And our view was that is going to stay steady up until elections. Keep in mind, you had ISM Manufacturing and NFP on Friday. You also had U.S. elections. You were also in the midst of mega cap tech earnings last week. You have FOMC as well this week, CPI next week, right? But our view is eventually you let those event risks pass, and that volatility risk premia has to normalize. What's interesting is you had an implied move of around 2% for the S&P heading into today's event. Futures are clearly realizing around 2%. The market feels quite efficient.
And it feels like, Guy, that this idea of this risk-on behavior you're seeing in the equity market, really, it was a lot of a positioning story as well, because going into this, it feels like there was that overhang we were talking about. And yet, on the rate cut front, a lot of the Fed cuts that were priced in for December now being moved to next year.
Look at the divergence this morning between what is happening with the Fed story and what is happening with the ECB story. Check out the front end of the European curve. Check out the long end of what is happening in the United States. Take a look at the work function on the Bloomberg. We're pricing out Fed cuts. We are pricing in ECB cuts. Is this a tariff story? Despite the fact that Trump didn't actually mention the word tariff in that opening speech, which is fascinating considering it's his favourite word, you would have thought it would be slightly higher on the agenda. That hasn't happened. So it looks like we are going to see some transatlantic divergence coming through here. But, Raphael, this feels orderly this morning. This feels, in some ways, this was what we didn't anticipate but should have anticipated but did anticipate. It's a kind of, we were all on the edge of our seats waiting for something extraordinary to happen. But I keep looking at the screens waiting for that to happen. It isn't. This feels like the market's got a handle on what is going on here.
So far, so good, we can say that. On the one hand, it's true it's been widely anticipated, front-run in some extent, for sure. On the other hand, it is the most disruptive scenario when it comes to economic policies, when it comes to long-term uncertainty. So, it's fairly early in the trading session. Let's look at what interest rates are going to do, too, talking about potential disruption. This is still clearly where the disruption could be coming from. And also, let's keep in mind that, political events and elections are part of the market narrative. They are part of the business cycles, but they are not necessarily long-term trend setters either. They can be disruptive in some ways, but what matters at the end of the day is what the market is pricing in terms of, earnings growth, macro development, to what extent the monetary policy in place will continue. That is what matters over the long end for investors.
Max, in terms of chasing some of these trades, we're seeing, for example, the turbine makers, as we mentioned, lower today, defence stocks getting a lift in Europe. Do you follow some of those, or is that already fully priced in at this point?
Well, what was interesting heading into today is where we actually saw the largest election-related risk premia baked in was, unsurprisingly, clean energy. Over the last couple of weeks, we had seen significant call buyers in the U.S. clean energy space in particular. It remains to be seen how clean energy reacts today. However, I think we can make a good guess as to how that plays out. Our focus has actually been more on U.S. energy. U.S. energy, particularly oil and gas E&Ps, feels like there needs to be a catch-up trade there, right? We did see the Trump 2.0 trade in areas like U.S. financials, banks, for example. U.S. energy has been more tied to the oil price. Oil is actually down this morning. But if U.S. growth and inflation expectations rise, especially if you get a red sweep coming to fruition, that's where we think the catch-up trade is in U.S. energy in particular.
How much of a challenge is the prospect of higher rates, higher for longer, from the Federal Reserve, and whether or not there are bond vigilantes waiting at the wings at some point?
Well, that's what's interesting, and especially heading into this week, the probability of Goldilocks, or the softest landing narrative via the equity markets implied probability, that has increased to above 50% based on our models. What has also sneakily risen in tandem is the implied probability of economic overheating. So everyone's been focused on this growth slowdown scenario. Where we think the underappreciated risk has been is what happens if you get the red sweep come to fruition, you get growth actually resurging higher, inflation resurging higher in the near term as well. And that's where the Fed potentially has to take the foot off the pedal in the near term.
It's an interesting point that you make on the energy story as well, because you did it from a kind of a clean energy perspective, which is far more, I think, receptive and volatile here in Europe than it is in the United States. But, Raphael, then there's the other piece of the energy story, which is that the United States is the biggest oil and right now LNG manufacturer in the world. How much of the support from the Biden administration can global energy markets count on when it comes to Trump? Is that something that maybe Europe should be more worried about?
Well, on the one hand, obviously, for traditional energy companies, it's going to be a boost. Deregulation is on the way. Trump is clearly a big supporter of this industry. On the other hand, we are right to wonder about what's happening to, the green transition. It's clearly a hiccup along the way.
Yep.
One feels, though, this is a long-term trend, something to capitalize on, not only because it's going to save the planet, but it's also a way to be more profitable, to be more efficient in the way companies are managing their energy needs. We see Texas, for instance, a huge energy and oil producer, investing in green energy as we speak. So this is not only a matter of a political will, but there is also an economic argument behind this transition to green energy that goes much beyond the election or what happens in 2024, 2025. So, hiccup maybe, but still a very long-term trend to bet on.
Can I just take a step back and just think about equities and risk assets and where we are? We went into 2016, last time Trump won. Equities are trading on 16 times, somewhere around there. We're on really punchy multiples now. We're starting from a completely different place. The risk, how useful is 2016 as a playbook in terms of that kind of risk-on narrative, tax cuts, the Trump trade pushing on? As I look at my screens this morning, is this a rally that I want to fade and maybe start to think about when I exit from? How do I think about this tactically now?
Yeah, I think you're right to start with the 2016 comparison and just realize that this is a very different story. As you mentioned about valuations, interest rates, they were 2%, we are 4.5 now. The fact that this scenario was somewhat expected by the market, so it's very difficult to apply the exact same playbook. The market is getting excited, rightfully so, for the fiscal package to be implemented. Some people are talking about 2, 3, 5% of EPS growth boost if it were fully to be implemented next year, for instance. So that could be a booster. What about tariffs? We don't know, and clearly that is going to be detrimental to potential earnings growth. So that's a mitigant. And also the key conversation here is about interest rates. We know that interest rates have been on the rise. It's part of the Trump trade. Rising deficits, more debt, meaning higher interest rate over the long run and potentially a steeper curve. There is a tipping point where the market starts worrying. Valuation gets constrained. Is it at 4.5? Is it at 5% on the 10-year Treasury? We shall see. And it might be too late when we realize. Yeah. But this is clearly the focus for concern here. We have some short-term gains potentially indeed. But what about the capacity of the market to absorb higher interest rate for what is going to be most likely a longer time period? That's still a question mark. And at 22 times valuation today, you don't really have a lot of leeway to support shocks, duration shocks. At least.
Yeah, markets pricing in 38 basis points of cuts from the Fed by the end of this year and below 4%, not until June of next year. We'll see how that adjusts, of course, with yields higher across the curve, as you say. Max Grinikoff, US equity derivatives strategist and UBS investment bank, and Raphael Thuin, as well, head of capital market strategies at Tikop Capital, staying with us. More analysis in terms of these markets through the next few minutes.
Let's go a little bit broader and bring in our expert panel. Max Grinikoff, U.S. equity derivative strategist over at UBS Investment Bank, and Raphael Thuin, head of capital market strategy over at TKO Capital, still with us around the table. I'm sure fighting the adrenaline that I'm fighting as well. Max, talk to us a little bit about the last thing that Raphael mentioned, which is that fiscal spend, specifically coming from the United States. So much of that has been wrapped up in the IRA. Pieces of analysis have suggested that in a Trump 2.0, some of that stimulative policy will still be there. How much of a wrench does that throw for the Fed's plans?
Yeah, I mean, investors that I've met with over the past couple of weeks in Europe in particular, one thing they've been worried about, and it's, potentially more rate sensitive than it is equity sensitive, but it's a significant sell-off in the longer end of the curve if you do in fact start to get these ballooning fiscal deficits, if tariffs are in fact escalated over the coming months or years. So it's more kind of a worry centric to the European economy, it has felt like over the past couple of weeks, whereas, look, within the U.S., infrastructure-related policy tends to be bipartisan. Right. So we, heading into this election, with the exception of the last couple of weeks, we have seen a rise in materials, in industrials, metals and mining in particular. That's been one of our calls as well. So you have seen that, priced in ahead of time. Whether that remains to be seen, of course.
And that pricing guy, I think, is so crucial because I think we've seen so much of it in the long end of the bond curve, the very long end that really shook a lot of the markets in, I believe, the third quarter of 2023. And yet we're looking at a 30-year yield that's rallying about 15 basis points this morning, and that's not considered a volatile reaction, yet it has an effect in housing, in mortgages, and, of course, the deficit story. That's the part of the curve that's exposed.
Absolutely. So this is a term premium story that we're pricing in effectively here back into this market. What happens at the front end, I think, is going to be really interesting. How far can the ECB go if the Fed is in a different position? How far can global central banks go if the dollar is doing what it's doing this morning and continuing to strengthen? What happens to risk assets in that kind of scenario, Tom? I think is going to be really interesting. It's interesting. We also heard Joe there talking about what is happening with some of the defense stocks and what is happening with Ukrainian miners. Does Europe get a... This sounds very counterintuitive this morning, but you could potentially see a cheaper euro, which could potentially be, you could argue, good for the Eurozone right now. Peace in Ukraine, is that something we can think about, price in, talk about, understand how that would affect risk assets? Is that potentially a good thing for Europe as well? I'm trying to understand what the sort of the counterintuitive trades around some of this is, because that, I think, is what we maybe have to do in a Trump-era kind of world and how markets are going to be reacting. I think maybe in some ways... It'll take a while to settle out, but I think there's some really interesting the sort of tectonic shifts taking place.
Yeah, so if you get a lift for defence stocks because Europe suddenly realises that, once again, it really has to spend on defence and it cannot rely on a Trump presidency and the backing of the US.
But what about Ukraine
become a peace dividend? And let's not forget, with a broader European story as well, what happens out of China. This is a pivotal week with the National People's Congress. And you get the sense from Chinese officials that they are waiting to give the details on fiscal stimulus to see what happens.
Do they stimulate more? Do they stimulate more in a Trump presidency?
You would have thought a higher likelihood out of China, given that they know there is very likely to be some range of additional tariffs put on. May not be 60%, but it's still going to be painful. That's the expectation, that they're going to have to ramp up that stimulus. Will that be a byproduct, in terms of a byproduct, a benefit for Europe, potentially? So we see the response from China. That's going to be crucial, I think.
What do you think about all of that, Raphael?
Well, on Europe, it's an interesting case study. Obviously, at face value, this is not good news. We are going to face tariffs in Europe. This is going to be impactful. By the way, 25% of European companies' revenues are generated with the US. So that's a lot to swallow. That said, when you lift the trunk and you look into the actual number, the actual share of it, which could be potentially impacted by tariff, is rather low. So back to what you were saying, a little counterintuitive thought here. You have peak negativity vis-à-vis Europe. Like the worst is almost certain in the mind of investors. Actually, when you look at the details, it is going to be impactful, but to what extent is it reflected in the prices to be seen? And then you have the ECB. We are going to get into an interesting setup that we haven't had in a long time, where we could see indeed a divergence of monetary policy. The past few years, by the way, have been fairly converging in terms of what we saw on both sides of the Atlantic in some ways. This might not continue to some extent. The Fed, on the one hand, will have to slow down, more inflation in the US, more fiscal packages on the one hand. On the other hand, indeed, Europe might slow down in the face of tariffs. At the end of the day, a diverging central bank could also be a booster for risk assets. So at reasonably cheap valuation in Europe, very negative sentiment, and maybe where a lot of negativity is priced in, maybe I would bet on Europe, indeed.
What do you think about that, Max? Bet on Europe? That's got to be the completely sort of counterintuitive Trump trade, isn't it? Bet on Europe.
Right. Like I said, over the last couple of weeks, and I think it ultimately does come down to tariff escalation in the coming months and years. There's been a lot of talk around the proposal of 60% on China, 10% on rest of world, and the potential legal process that has to go through. 60% potentially looks more likely on China. 10% on rest of world could be a lengthy legal process over the coming months and years, where the Trump administration might not be able to get that through.
How much does policy actually change, though, in that? I mean, you're saying that 60%. It was an offhanded comment in a Fox interview. How much does policy change, given that the tariffs have stuck through the Biden administration that were first put on during the Trump administration? And I'm wondering how much of that maybe has a background of calm in these markets. Right.
It's comparing what has come through the Biden administration, as you allude to, post the first Trump administration. Look, at the end of the day, it is China-centric. Raising current tariffs to a 60% threshold, that could likely, invoke some pushback from Congress. Yeah. However, a lot of that power has been passed on from the legislative branch to the executive branch over the last 8 to 10 decades. So.
Yeah, you have to wonder as well whether Trump puts Europe in a basket, because we know he has ties with the likes of Viktor Orban over in Hungary, but Germany feels like a stone in his shoe in terms of the annoyance that he sometimes reflects when it comes to that country. Max Grinikoff, US equity derivatives strategist at UBS Investment Bank. Raphael Thuin, head of capital market strategies at Tico Capital Management. Thank you very much indeed, both, for your analysis on this historic day.